Excellent. Let's get rolling. I think, we'll see some more people trickle in as we get going. But um, first of all, thanks everybody for joining. Appreciate everybody taking the time. My name is Danny Condon. I am the Chief Revenue Officer at Blockware Solutions. Um, we've got quite the lineup today, and as Mitch was mentioning, we've got plenty to talk about. So a little bit of the agenda for today. So I'm going to be hosting, kind of moderating today's session. We've got Warren Rogers with us. Warren is the Chief Financial Officer at Blockware. He's going to be covering macro, which I think is going to really set the tone for this discussion because everything's kind of trailing. Everything's all these markets are reacting to a lot of macro news. Fed today, so I'm sure we'll have a lot of exciting news coming from Warren. Then we have Blake Davis. Blake is a crypto equities analyst at Blockware Solutions. So he's going to be covering crypto, a lot of this, or crypto exposed equities. Again, a lot of this is dovetailing from the macro perspective. So I think it's a good segue from Warren to Blake. Then we're going to move over to Mitchell Askew. Mitch is another analyst at Blockware Solutions. Mitch, I think this is the first time that you've I know you're very active in the newsletter kind of recap, but I think it's the first time you've been in this session. So stoked to have you a part of this. Mitch is going to be covering what he's seeing from a on-chain and just more Bitcoin specific perspective. Then we have Joe Burnett. Joe is a head analyst at Blockware Solutions. Joe's going to be covering mining. What he's seeing in that world. We just released a report in collaboration with Riot Blockchain. So you can talk a little bit about that, and we'll have some fun. I think we've got it. It's been at least a month since we've done the last one, and certainly a lot has happened since then, and we're looking forward to diving in. Before we get going, just for those of you who don't know, I'd like to give just a brief overview of Blockware Solutions, so you know a little bit more about who we are. Our core business is vertically integrated Bitcoin mining, so we provide turnkey Bitcoin mining solutions, inclusive of brokering hardware, providing co-location hosting services in our own and operated data centers. We operate a pool, and we provide miner management software. So we make it super easy for individuals and institutions who are looking to get exposure to Bitcoin mining. We're always happy to chat, so if anybody's interested in learning more about Blockware or the products and services that we offer, certainly feel free to holler. You can hit us up, via DM, or you can hit up sales@blockwaresolutions.com. With that, why don't we get it rolling? Warren, take us into the macro landscape, man.
Hey, everybody. Yeah, it's no shortage of exciting events. Here at Blockware, we've spoken widely about our views on inflation and our macro outlook, and continue to be proven correct in regards to the path of the markets, inflation, and forward expectations. As you've all no doubt seen today, the FOMC raised rates by 75 basis points to the range of 3 to 3.25%, which is the highest since 2008. This is in response to the consistent, persistently high inflation data. This rate path suggests that the Fed funds rate is approximately 4.25% by year end. I still find the forward rate expectation to be unrealistically low for 2023, showing us that the market does not understand the severity of the inflation. What this is going to do, the knock-on effects, are things like your mortgage rates are going to go sharply higher. The 30-year fixed rate mortgage today is about 6.25%. That'll no doubt be about 7% by next month in my estimation. The root cause of all this is persistently high inflation. August inflation data was stubbornly high again at 8.3%. It's a softer print than the previous month because of slightly weaker gasoline prices. September inflation, to be released on the 13th of October here in a few weeks, looks to print higher as gasoline prices have edged up again in response to more saber rattling in Ukraine and fears that the oil market will tighten. This is very dangerous because we're getting into the heating season. It's our view that this data is going to continue to edge much higher over the coming months. Heating costs are central to this. When you look at the cost of electricity, the average retail rates, which affects Bitcoin mining, heating your house, industrial production are up sharply. Coal is in the first real bull market it's had since the 1970s. You have natural gas. It was recently over $9. It's around 7.5 now. The prices of these commodities are going sharply, sharply higher, and the one who's losing here is you and me. We are going to get squeezed here, and there's a very, very difficult path coming out of this. We think that there's going to be a 10% inflation, print in the next few months because of all these factors. Basically, in our estimation, the Fed is nowhere near done raising rates and will continue to play catch up to slow down the economy. I would predict that if we do see 10% inflation numbers, the Fed's rates are going to shoot over at least 7%, maybe even in the first half of the year. This move clearly spells doom for the markets and consumers alike. We've seen a steady stream of corporate restructurings, layoffs, negative sentiment throughout the economy, and look for this to continue in the coming months. The gamble that the Fed has been playing is that they can perfectly walk the tightrope and raise rates without tipping us into a recession. This sort of surgical precision is nothing that a appointed or an elected official has ever done before. We highly doubt this is possible. It's interesting to point out that the unemployment rate is still under 4%, 3.7% to be exact. There's no doubt in my mind that this is going to work much higher. The evident strain on the economy is going to lay waste to millions of workers. It seems very clear that a recession is near. This inflation is a persistent global problem. In Europe, where they are particularly hard hit by inflation, the UK over 10%, EU over 9.2%. We think this works materially higher in the next few months, mainly because of energy prices. Check it out. Natural gas prices expressed in the oil barrel equivalent are over $500 a barrel right now. Stockpiles of natural gas have worked to their lowest levels. They can only withstand a 1 standard deviation weather event before running completely out of gas. It's already off to a colder start to the winter. Russia has already shut off gas pipelines, and people are running scared. This astonishing move, is in response to senseless national energy policies and smoking hopium of renewable energy. The war in Ukraine and Russia's aggressive posture showing them that they have much more, fantastic energy dependence than they ever would have admitted. What's worse about this is that inflation always hits the poorest the hardest. Food prices are up dramatically globally. They're going to in the developed and developing world, they're going to continue to work higher. We have a very strong chance of massive food shortages as this has now been weaponized by Russia. The net is obvious. The macro is continuing to degrade. We look for continued repricing lower in the S&P and other markets. With the government's hands tied in regards to new stimulus, we see a chances for, a sort of longer recession or, just slow growth period. This doesn't spell doom necessarily in my view for Bitcoin. As I've said numerous times, my view on Bitcoin is that it's three things to me. Number one, it's a technology for the transmittal of financial data. Number two, it's a currency used to buy things of value. And three, it's a commodity because it takes energy to produce it and it can be used as a store of value. You've all seen, because of this trifecta, Bitcoin has trouble sometimes finding its feet. In my view, you're going to see in this, degrading macro picture, my personal view is that there's going to be more support in Bitcoin developing. That is mostly because of its engineering. It's engineered to fight inflation, but it's just kind of trapped into itself right now. Though I think that there's not an insignificant chance that prices stabilize in the coming months and do trend higher simply because of the inflation demand. We have these counter forces, where now your 2-year rates are over 4%. There's now a premium for taking no risk, but at some point the markets do demand a risk premium. The other side of the trade, risk trades remain very complex, making, just long only strategies difficult to manage. I think this is a perfect example of those who dollar cost average into anything, but in this case, Bitcoin, are going to prove much better off. This in summary, it's a highly confusing macro picture. The stock markets are starting to get chopped up even more, and we're continuing to focus on data that will no doubt, in our view, well, I should say, in our view, trend higher over the coming months.
Hey, Warren, love it, man. I want to get your perspective on one thing, or just one thing that I was thinking about earlier today that you kind of hit on there. Like, on the brink of what very likely could be a recession, and just kind of looking to history, right? Like, I'm thinking about 2017 or 2007, sorry, 2007, 2008, 2009. Like, I remember when basically that was, a different kind of fundamental event, where there was a strong correlation. Yeah, I'm trying to think about how to kind of articulate this, but really where it's kind of like a game of chicken, right? And we have a kind of a game of chicken between like the Fed, the markets, unemployment, right? And the employment numbers, to your point, are pretty good right now, right? So
Mhm.
it's like, okay, keep pumping this. And then inflation keeps generally going up or not tapering off as fast as we'd like to see to lay off some of these rate hikes, right? So this is a dangerous game. And as I look back at, 27 2007, 2009, I remember it was almost this kind of sentiment in from a market's perspective, and this could be a good segue to Blake too, of like bad news on an economic data front is good news for the market because it led to more quantitative easing. So it's kind of like, okay, numbers are still bad. Markets go up because
Yeah,
money becomes cheap, right? And
yeah,
this is like a different situation where, you know, if you look at these same variables, we have pretty good unemployment numbers currently, at least from a reportable perspective. Then we have raging inflation, and we have, the Fed trying to combat that. Now, as you look at like those three variables, what do you think? I mean, I know you were quite active and probably capitalized on that downturn in a similar way. Like, do you see us approaching a bad news is good news for market to some
yeah.
degree, where
It's a great
or is it
question.
like it's just a different fundamental underlying where they don't have the ability to pump off rates because it's inflation, it's not unemployment? And then what happens if unemployment starts raging? Do they have to back off, and just let
Yeah,
the party go on and let inflation rip? And that's just the new normal. And what do you think
yeah.
there? It's a long-winded question, but I'd love to hear your thoughts.
No, no, this is a great question, and the answer is it is very complex. And what I see here is that, this is why I don't think that the Fed can walk a tightrope because there's so many variables here. For example, and one thing, the Fed is having an impact on real estate prices. Where I'm from in Austin, Texas, I mean, it's like there's a price cut every 5 minutes on the homes there. Rents are starting to go down in some cities. But on the same thing, those will rents will also decline as more people are becoming unemployed, and that's clearly bad. The bad news is good news phenomenon is something that I've followed for many years. And in this scenario, I can see how we start to get bad data, like unemployment, ticks up significantly and the Fed does hit the pause button. However, I would say that their goal is to slow growth, and that's a target at GDP, which a factor of GDP is employment. And so, in my view, unemployment would have to jump substantially, for the Fed to back off. It's not going to be 1 or 2 months prints. It would have to be like 6 months and probably go over 5%, which is their optimum sort of stated level. I think, in these scenarios, the Fed is just going to be much more cautious. But, you think of the disaster going into a recession with, very high food and energy prices and with, unemployment picking up. So you'd have, fewer people working, less money to buy food, food's more expensive. it just spells doom for the economy. And so there's going to be a lot of caution. And so the net here means that it's going to be very, very whippy. But I just don't think we're into the market yet where the Fed is going to, treat every data point with such resonance when they're really focused on top line inflation. I'm not sure if that really hit the question on the head, but it's just so confusing. It's and complicated. It's difficult to answer.
Yeah, for sure, man. No, I mean, it's not as simple. It's not a simple answer to your point. There's so many variables. Um, there's so many levers to pull, so many outcomes that uh, that play out as a result of these levers being pulled. I think it's clear, for the short term, in until we start to see a material, negative impact on unemployment, which is a primary mandate to retain employment. Like, they're going to keep nuking this thing because
Yeah.
because it's about keeping people employed is the ultimate objective, and tampering inflation is part of that, right? So,
Yeah.
anyways, appreciate that. Anything else you want to add from a macro perspective? I'm sure we're going to dovetail back to this, but otherwise, let's move over to Blake.
Yeah. I can't wait to hear.
Yeah, Blake, what are you seeing from an equities perspective, and specifically as you kind of get into it, Bitcoin exposed equities?
Yeah, so I kind of want to start from a macro lens and kind of recap a little bit of what Warren was saying, and so then I can tie that into what we're seeing, in the market and with price action. So currently this current 3 to 3.25% range for the overnight market interest rate that FOMC announced today or put us at today puts us in what Powell referred to in his speech today as the quote, very lowest level of what might be restrictive. And what that means from his perspective is that the Fed is envisioning this range of interest rates that would potentially have the ability to suppress demand enough to bring down inflation. So what the Federal Reserve believes is that that's that 3 to probably 4.5% range would be my guess. So what that means, if you're taking the Fed at their word, is that we still have a ways to go in terms of rate hikes and that time required, leaving interest rates elevated in order to lower prices. And I think that's kind of like the key of what happened today and what's been going on over the course of 2022 is the fact that a lot of people have grown accustomed to, oh, is it going to be 50 basis points, 75 basis points, or a full percent? Like historically, those are insanely large increases to the Fed funds rate. Obviously, in the 70s and 80s, you saw 2% increases, but that was a very unique period of time. In the last 40 years, we haven't really seen anything to that degree. So that key is just that there's still a ways to go, and it's going to take a lot of time. And Powell talks about this a lot, where he says, we're going to raise interest rates to a certain level, and then we're just going to leave them there for as long as it takes. So this is going to take a ton of time to play out. And that kind of goes without mentioning the fact that even a 4.5% Fed funds rate likely won't be enough to restore stable prices. In my opinion, I think it's probably going to take higher rates than that. And Warren touched on that a little bit too. If we continue to see CPI climb, or see it climb as it was earlier in the year, it's likely going to take a higher Fed funds rate than what they're expecting and what their terminal values are at. But that 75 basis point hike was what the market was expecting. And there's a few ways we know that. I think the easiest way is just looking at CME Group's Fed Watch tool, which just tells you the probability of certain rate hikes based on Fed funds rate futures data. So we can kind of gauge what the market is expecting in terms of, or what they're expecting from the Federal Open Market Committee. But just because we got what the market was expecting doesn't mean that we were going to see a bounce in the markets. And I think that's kind of what everybody thought, or I should say a lot of people thought. A lot of people that I saw on Twitter were saying, if you get a 75 basis point hike, that's what the market's expecting. That means we bounce. And the fact of the matter is that we got, quite the opposite of that today. And obviously, one day of price action isn't enough to, say how the market is going to react to this, over the near term. But that downside reversal today that we saw was pretty nasty. And I think the market proved that, even though 75 basis points was probably priced in, the market is clearly not at the point where bad news is good news, Danny. Like what you were just talking about, because that bad news is good news thing happens around market bottoms, and that happens around the bottom of bear markets, right? I think like one of the best examples of it, and it's recent and everyone remembers it, was 2020, where it was like the market bottomed in March when COVID news was at its absolute worst. And obviously this is completely different scenario, right? With what's going on in the macroeconomy and with the central bank, versus a global pandemic, it's different. But from an investor's point of view, it's about future expectations and about fear. So in 2020, markets bottomed when the news was the absolute worst, and it gets to that point where people are so scared or so bearish about the future of the economy or the future of the markets that there's no one left to sell. And I think today just kind of proved that we're clearly not at that point. And I think a lot of people expected us to be at that point. And I think, in my opinion, I think it's possible that we're near that point. But I just think, Powell's tone today just scared a lot of people, and it just kind of proved that the bottom is most likely not it. And Powell's tone was, I thought, pretty neutral today. He had a few statements that were fairly hawkish, and obviously the market didn't like that, based on today's price action. Furthermore, I think Treasury securities have been selling off for a long time now, but in the last week or so, since August CPI numbers came in, that selling's really intensified. Today, obviously, like Warren mentioned, 2-year yields crossed above 4%. And this just says to me, at least, that although headline CPI inflation may be coming down slightly, in the near term of the last couple of months, we're super far from being out of the woods. And that kind of ties back to the time that it takes, like I mentioned earlier, the time that it takes of raising interest rates, before we see some of the economic conditions, lighten up. And just shows that, we're, like I said, very far from being out of the woods. And I think that the Treasury market is signaling to us that the Fed has even more work to do to create price stability. And there's, still likely pain to be felt from investors, in my opinion. But pivoting to crypto equities, I think that, crypto equities unsurprisingly look very weak from a price structure perspective. And I'm just talking about in total as an industry group, and I'm not talking about a specific stock. But I think the reason for this, and the way that I like to think about crypto equities, is that they're like an ultra risk asset, or they're maybe like a double risk asset, if you will. But what I mean by that is that first they're equities, obviously, so they're publicly offered shares of companies, which means that they're subject to a variety of risks, right? That makes them pretty volatile in comparison to other securities, right? But furthermore, they're tied to Bitcoin, and I think in the eyes of institutions and institutional investors, which are the most important ones to pay attention to, because they are the ones who drive these secular price movements in financial instruments. Bitcoin and crypto assets as a whole are considered extremely risk on assets. So obviously, as Bitcoiners, we would disagree for a variety of reasons, right? Immutable scarcity and self custody and supply side predictability. But I think the fact of the matter is that at the moment, institutions don't really care about that, right? They're more focused on protection of wealth, and it's pretty hard to do that, when something is so far off its highs and so volatile. But that being said, and obviously, I think that is going to change in the future. I'm a Bitcoiner, right? And I work for a Bitcoin mining company, and I'm extremely bullish on the future of Bitcoin. And I think that all being said, these companies, or I should say, many of these crypto exposed equities, aren't going anywhere. And I think, Bitcoin certainly isn't going anywhere. And I think this market has proved that. But I think, this is one of those necessary cleansing events that we always see in bear markets, and that, the best companies will survive, and, it is possible that some might not. But I think, from the perspective of a long-term investor, it's an unbelievable time to be dollar cost averaging. We've seen a discount on these companies that we've never really seen before. A lot of these companies haven't been public for very long, and they were just trading at 80-90% higher just a year ago. So I think it's a great time to get a discount. I think look for companies that you've done your due diligence on, and companies that you really believe in, and obviously Bitcoin itself, and just dollar cost average is kind of the point I'm at. But yeah, I think that kind of gives a pretty broad perspective of what's going on with the equity markets and crypto exposed equities. But if anyone has any questions, obviously I'm open.
Yeah, it's awesome, Blake. No, appreciate that. I think we'll probably circle back to equities and everything. We're going to continue to circle back on the macro landscape, because to both of your points, that's really driving everything right now. Let's move to Mitch. As we kind of go down the ladder here, talk from macro to equities, and now what do you see in Mitch from a more Bitcoin specific perspective? With regards to on-chain activity and just, in general, you've got creative control. What are you thinking, man?
Yeah, so you guys really hit the nail on the head there with the macro stuff. I'm going to leave that to you. I definitely, people a lot smarter than me are confident that the short term is going to be incredibly bearish. It's going to be bad. But when I'm looking at the on-chain and Bitcoin, for the long term, I could not be more bullish right now. And I mean, first off, anecdotally, we saw NASDAQ and BlackRock last month have adopted Bitcoin. So the underlying adoption curve of Bitcoin is not going to be slowed down. We did a research report a few months ago on adoption, and something that I kind of wish at the time I didn't really, this thought didn't cross my mind, but how do recessions affect adoption curves? And when I look at the data we got for past adoption curves, not really. The Great Depression it slowed down adoption curves of like really high variable cost goods like cars. But when you look at the internet and social media through the 2008 recession, those adoption curves didn't get slowed down because the market, that we were in a global recession. So that's just something to keep an eye on with Bitcoin. There's no cost to becoming a Bitcoiner, right? Like anybody, even if the economy's in the worst position, if you learn about Bitcoin and you realize that this fixes a lot of the problems that we're talking about, there's no cost to begin saving in Bitcoin. Like it's never too late. And a lot of us in this space, we know that Bitcoin fixes the problems that we're talking about. The really high inflation, now the Fed is having to pull back and slow growth to reverse that. Bitcoin fixes that, and we understand that. So switching to the on-chain stuff, when I'm looking at Coindays destroyed right now. So this is basically a measure of when coins are older and they've been moved, that gives more weight, right? So like 10 coins moved that haven't been moved for 10 days, or that get moved 10 days after being moved, that's going to be 100 coin days destroyed. So what this measure basically shows is like the opportunity cost of holding, right? And the confidence. So right now the opportunity cost of holding is roughly $20,000 worth of Bitcoin if you wanted to sell it. But when Coindays destroyed, it's really low. It means there's high confidence in the market that Bitcoin's going to go up further from where it's at. You see a lot of coins move during the bull runs. People aren't entirely sure that Bitcoin's going to keep going up after that. But right now, the confidence in the future value of Bitcoin is incredibly high. You can look at the reserve risk. This ratio basically shows the same thing. It shows the risk reward ratio of Bitcoin right now is as good as it has ever been, even relative to past bear markets, right? In past bear markets, we didn't have all this adoption. We didn't know that Bitcoin was going to survive when it drops to $100, $200 range in 2015, 2016, when it dropped to 3,000 in 2018. There's still like a degree of uncertainty about Bitcoin's future, but the industry is so large right now, and the floor is 20,000. Like people know it's not going anywhere. And if it's not going anywhere, then it can only go up when you have this underlying group of people adopting Bitcoin as their personal treasury reserve. But there's a limited supply of 21 million, right? Blake was talking about Wall Street. It's right. They haven't recognized what Bitcoin truly is, but a growing percentage of the population is truly understanding Bitcoin, and it's becoming their safe haven asset. It's certainly my safe haven asset. It's, even if the whole world is chaos, right? And nobody really has anything, my Bitcoin's gonna be the last thing I give up. I'm gonna hold that for as long as possible. When you look at the HODL waves, 65% of Bitcoin supply has not moved in 1 or more years, and 45% hasn't moved in 2 or more years. So the HODLers are staying strong. They're not going anywhere. all of the valuation metrics are still in the buy now range. They're screaming to buy, and of course things could go lower with the macro, but dollar cost averaging is the way right now. If you dollar cost average, you're guaranteed to buy the bottom, at least a piece of it. You'll get some. If you're not buying here in hopes of being able to snag 10K Bitcoin, when we know this thing is going to be worth millions of dollars, you're only going to hurt yourself when you do that. There's another metric I'm looking at, and all of these charts, they'll be in the newsletter release on Friday. It's the cumulative value of coin days destroyed. So it takes the coin days destroyed, it multiplies it by the price, and it does a cumulative sum of that over time. And every time in the past bear markets, we've basically touched this line, and we haven't really dipped below it. We're not there yet. If the past tells us anything, the bottom would be around the 14,400 range based off of this metric. But again, that's not saying go put a levered long position at 15K, because nobody knows for sure. But based off this metric, we only have a little bit lower that we would realistically go.
Mitch, that's great. We got a question and a concept to kind of throw out, for you and maybe the group, with regards to adoption. Something you hit on right at the start is, I think we'd all at least conceptually agree that we are early in the Bitcoin, evolution and path towards, hyper Bitcoinization, right? And that adoption is kind of at like not to mix the use of a term, but kind of at like a Bitcoin macro, from a Bitcoin macro perspective, that adoption is key. And, you talk about like, well, what could put a damper on adoption, right? Which in turn could, deter, future price, positive price action, growth, investment in the network and just ecosystem, right? It's bigger than just like Bitcoin price action. And a concept I've been thinking about a lot about is, and generally think about when I think about, markets and allocation of capital, is effectively opportunity cost, right? Every single action you make, whether it's, with allocating capital or your time or anything, everything has an opportunity cost. And then I'm also looking at, a fundamental objective being to maximize your return on capital, and that really brings the picture into, everybody, not investment advice, from an opinion, but I'm using this example. Everybody's objective is effectively to maximize their return on investment, get a disproportionate return on an allocation of capital relative to alternatives, right? And if I'm looking at like, okay, well, is the adoption thesis intact right now? And I keep all signs point to yes, largely because where the hell else are you going to put money right now, right? It's kind of like, if Bitcoin, to play this out in an inverse capacity, if Bitcoin price action were getting nuked while, real estate prices were on the rise, equities were on the rise, it's reasonable to assume that, in light of that, quest for a disproportionate return on capital, that we may see, a downtrend in adoption, right? But because of this, kind of makeup in the market where Bitcoin is basically just trading at a higher beta, kind of risk on asset, kind of in that paradigm, I kind of think that the adoption, if anything, this could speed up adoption, right? Because it's like, you look this way, oh shit, you look that way, oh shit. It's really like people are looking for disproportionate opportunities, and there's a lot of factors that go into adoption aside from opportunity cost and return on capital, education, awareness, education, so on and so forth. And I think that those vectors are intact. People are still investing, people are still learning, people are still putting content out. We're still doing Twitter spaces, right? What do you think about that as like a kind of a concept here about adoption continuing to gain momentum in light of like a lack of uh, alternative allocation of capital, at a more disproportionately positive gain, right? It's kind of like there's no better option, right? I mean, is that crazy to think that way?
No, not at all. I certainly agree, and I think there's been a huge mindset shift here in America around inflation. Like you go back 3 years ago, I don't think anybody really thought that that was that big of a problem. Even if inflation's just 2% compounding, that steals a lot of your money, not a very long time. But now that CPI, which is a garbage lowball measure of inflation, is almost 10%, and everybody everywhere they go sees it. They understand that even the dollar now is not a safe place, and all assets are getting wrecked right now. And I think if you're trying to explain Bitcoin to someone, all you have to do is just point at the inflation and the manipulation of the money supply by the Federal Reserve, and I think that's going to do numbers on chain. This is in the newsletter last week, but Bitcoin entities with less than one Bitcoin have been stacking very aggressively during this bottom of the bear market. Well, I don't want to say bottom, but during this bear market, even at a more aggressive rate than during the previous bull runs. So I don't think that's incorrect at all, Danny. I think adoption is sort of price ignorant at this point.
Right on, man. No, appreciate it. Let's. I mean, one of your key themes there was like don't time. Like just thinking about your personal strategy of dollar cost averaging in. Best way to dollar cost average is mining. I think it's a good segue over to Joe. What are we seeing from a mining perspective?
Yeah, absolutely. I'm mainly this week in this space going to cover the report that Blockware and Riot Blockchain put out. And the full report's, on blockwaresolutions.com and Riot's website as well. And Pierre Richard, who's the VP of research at Riot, and I did an hour-long Twitter space earlier this week that's now on the Blockware Intelligence YouTube. So if you really want to dive into this report, check that out. But I'll quickly go over 3 key points of the Bitcoin transaction fees report that we published. Definitely not really macro related, but it is kind of bullish long term Bitcoin. And the theme of the report was trying to analyze like what is the long-term security of Bitcoin after the block subsidy goes away. Like right now is pretty much all of us know, there's only going to be 21 million Bitcoin, but right now there's about 19 million Bitcoin that exists, and every 10 minutes miners are mining 6.25, roughly every 10 minutes they're mining 6.25 Bitcoin per block plus transaction fees. So miners are getting that new coin, but in the long run, that subsidy is going to zero, and miners will just be earning transaction fees. So, is the security of Bitcoin in the long run at risk? And so, there's 3 key points in the report that I'm going to quickly cover today. The first one is that mining is not about Bitcoin's quote unquote security; it's about settlement finality. So, Bitcoin's security and consensus rules are defined by private key storage and nodes, respectively, not miners. So no matter how much or how little hash rate is on the network, miners cannot force your node to accept more than 21 million Bitcoin. They cannot raise node cost constraints like the block size limit. They cannot create a valid new transaction that steals your Bitcoin. And they cannot alter any other fundamental consensus rules on the network. And this is why the block size war from 2015 to 2017 was so important. It affirmed that Bitcoin's core consensus rules are immutable and they're enforced by individual users, which are Bitcoin node operators, and they're not enforced by large corporations, exchanges, miners, developers, or any government. Um, but from a malicious miner perspective, the Bitcoin network fee market of users transacting on Bitcoin makes Bitcoin resilient against any miner adversaries. So if miners are 51% attacking the network and they are censoring transactions, the natural market-based response to that is for transaction fees to increase. If users cannot get their transaction confirmed in a block, they will simply raise their fee, and that incentivizes more miners to come online, mine valid blocks that contain legit Bitcoin transactions, and all of a sudden transactions start getting confirmed again. And if users are worried about settlement finality and they think that it's possible that Bitcoin's quote unquote security is at risk, or there's a risk of a 51% attack, they can simply wait for more confirmations. So the theme of the report is long-term Bitcoin security is fine. If receivers of Bitcoin fear an attack may occur, they can just wait more confirmations to have more confidence that their transaction will settle. And this isn't really like theoretical either. This has already happened with like Bitcoin Cash, Bitcoin SV, and other altcoins. So there are still transactions, being broadcast and confirmed on these networks, and users are still buying and selling these coins on multiple exchanges, even though the quote unquote security or settlement finality on these networks is far less certain than Bitcoin. So these exchanges, though, they require more confirmations to consider a transaction settled. So some exchanges require 100 confirmations for Bitcoin Cash instead of like traditionally it's depending on the exchange, it's about 6 for Bitcoin, but 100 confirmations is still less than 24 hours, and it basically helps protect the exchange from any sort of double spending by increasing the amount of work, time, and energy that would need to be consumed in order to perform a 51% attack and reverse the transaction. So the conclusion of this first point in the report is basically 51% attacks can be omitted by having users wait for enough confirmations to increase the assurance that their transaction has settled, and just this idea or doing this discourages attacks because it makes them even more expensive. So Bitcoin is kind of anti-fragile in this way that if that there is this natural fee market that comes in if there are malicious miners and if they do decide to put any sort of attack on Bitcoin. The second key point of the report is this idea called Bitcoin's scaling cycle, and there's a good graphic in the report on our website. It kind of talks about the idea that Bitcoin goes through these really crazy price cycles where there's massive parabolic bull runs. This happened in 2013, 2017, and 2020 and 2021, where there's a lot of adoption. People are withdrawing Bitcoin off exchanges. They're sending it to their hardware wallets, their multi-sig wallets. They're sending it back to exchanges. They're doing all this sorts of stuff on the Bitcoin network. And during these times, fees increase. And when fees increase, that's fantastic, but for miners. But at the same time, users don't really like high fees, right? So demand for lower fees kind of increases, and this is where we get the idea of more scaling technologies. So this can be things like Lightning or SegWit or exchanges batching transactions. And so high fees kind of lead to developing more scaling technologies, and then fees kind of come down a little bit, and then we get that next wave of adoption where more people join the network. The network is more efficient with block space because of these scaling technologies, and fees go back up again, and miners benefit big time. The third and final key point of the report is just talking about like future Bitcoin adoption. So this is, Blake and Mitch mentioned this in our adoption report that we previously published also on the Blockware website. But using Glassnode data, we previously estimated that there are about 32 million entities that currently store wealth on the Bitcoin blockchain. And, virtually all of these 32 million entities are using Bitcoin as the store of value. It's a commodity, right? But they're not using it as a medium of exchange. So what kind of happens if there are 7 billion entities for 7 billion people, and they're all using it as a store of value? So that's going to be a 220x roughly increase in entities competing for the same amount of block space. So that's going to be, a lot of scaling that needs to be done. And there's just going to be periods, in the future when transaction fees really soar. But on top of the billions of potential future Bitcoin users just looking to use Bitcoin to store a large amount of their wealth, I think it's possible that one day Bitcoin itself may be used as like a payments tool or a medium of exchange. And this would be like a period where transaction throughput on the Bitcoin network really starts to get tested, and transaction fees would likely soar, right? Because users are no longer transacting 1 to 5 times a year, moving their Bitcoin from one exchange to their cold storage or from their cold storage to an exchange. Now they're transacting, 1 to 5 times per day potentially. And with more and more individuals, using Bitcoin as a medium of exchange, throughput would have to increase from today. It would have to increase 80,000x instead of just the 220x for the store value use case. So, as mentioned before, this increase in throughput may incentivize or will incentivize the adoption of second and third layer scaling solutions like Lightning. However, all of these scaling solutions are still anchored to the first layer of Bitcoin, like opening and closing and rebalancing Lightning channels. They always will rely on the Bitcoin blockchain to be secure and permissionless. So high value transactions, also to and from cold storage will likely always be done on the first layer to minimize uncertainty. So I think high on-chain fees, which go to miners, will likely to, continue to motivate more development of scaling solutions. And many of these scaling solutions may be like completely unknown today. However, for throughput on the Bitcoin blockchain to increase by 80,000x over the next 20, 30 years, there's likely going to be very high periods of very high on-chain fees, which with each wave of new Bitcoin adoption. And at the end of the day, I think this is great for mining because whenever the next wave of Bitcoin adoption comes in, not only will the miners be capturing the massive future upside in the price of Bitcoin, but this new adoption will come with periods of higher fees, which is just another kind of double whammy for the miners to really increase their revenue.
Joe, that's great, man. And I just made it through the report. I think it's super insightful, and it's something that's not talked about, that much, right? Like, there's more than just the block subsidy and the yield associated with mining that often gets overlooked. And a lot of people get the question of, well, what happens when all the Bitcoin are mined, which we know is kind of like a Pythagorean theorem with the programmatically coded deflationary monetary policy. But it's good to bring that to the forefront as well, which is I think a good transition too into what are we seeing from like a mining yield perspective. And again, for those of you who change this regularly, you're probably sick of me referring to Bitcoin miners as effectively dividend paying assets. But again, there's two sides to this equation. There's the CapEx on the hardware, right? And that's largely correlated to the price of Bitcoin. And then there's the yield, which is largely a byproduct of Bitcoin price if you're dollarizing it, and difficulty at any given time. I mean, difficulty remains insanely high. The Bitcoin network has never been more secure, right? That's a good thing at the core. What are you seeing from kind of that perspective, and what's the optimistic look? Yeah, I mean, you can hit the whole spectrum from a pessimistic and an optimistic perspective, but one thing that I always find interesting is the correlation between like a perfectly positively correlated, opportunity as you look at Bitcoin mining being a multi-year strategy in some cases, right? What are you seeing from that perspective?
Yeah, I mean, difficulty hitting an all-time high is crazy, but it makes sense, right? Like, there's still these new generation machines that are getting deployed all around the world. They're so efficient that, believe it or not, even with the low price of Bitcoin, they're still operating profitably if you have relatively cheap electricity. So yeah, I mean, I think that a lot of people can look at Bitcoin mining rigs as these quote unquote assets that the price of them have like a high beta to the price of Bitcoin. Of course, they do decay over time, like any sort of hardware. But if Bitcoin goes up in the short to medium term, these mining rigs can rip higher too. But yeah, no, it's interesting seeing difficulty hit a new all time high. I think it's a sign that more and more energy and more resources are getting poured into the Bitcoin ecosystem, even during these quote unquote dark bear markets that we're in.
For sure, man. Love to hear Warren's take on this too. Like one way that I look at Bitcoin mining in comparison to, just like us buying spot Bitcoin, for example, is, like relative to buying spot Bitcoin is pretty straightforward. Bitcoin goes up, your investment, relative to a liquidation of sorts, but you make money. Bitcoin goes down, you lose money. It's totally binary, right? One thing that I think is very interesting about mining is that you pretty much are going to be profitable. You're going to be making money in up markets, in sideways markets, and in down markets, right? So it's kind of like in this environment right now where breaking even is like, you're kicking ass, right? It's kind of like the downside hedge narrative becomes a lot more appealing because, a downside hedge, Bitcoin price, continues to move in a negative direction, it can still be profitable. And then the beautiful thing about the natural economics of Bitcoin and incentives of Bitcoin, Bitcoin mining is that you have difficulty as this kind of natural correction mechanism. And how much are people going to bleed if they're not making money? Probably not that long, right? Maybe stick it out for a few difficulty adjustments, but at some point, lights go off, right? I mean, Warren, what do you think about that as you look at kind of two? I'll net this question out as you think about Bitcoin mining as one, like a dividend paying asset, taking into account the value of the hardware and its correlation to the price of Bitcoin and some other, less, some other factors. And then two, Bitcoin mining is a downside hedge, right? I mean, it's a little bit atypical to think about it that way, but right now, not losing lots of money is winning, right? It's crazy times.
No, that's a great question. This is pretty interesting to throw this one around a little bit. One of the things to think of in Bitcoin mining, it's actually like you're accumulating an asset, and that asset has a book value or on your personal balance sheet, and you can depreciate that asset over a number of years, and so it has some unique characteristics, and so you're even buying Bitcoin for less than you would if you were just buying a Bitcoin. All these factors come into play and things like that. But, when you dollar cost average in something or just allow yourself not to take, just delta one risk immediately in something, you give yourself a chance to be wrong. And that's just, everybody gets into mining and investing and buying a house or anything else with the best intentions, but the path is never linear. And what we're seeing now in Bitcoin is just a non-linear, maturity in a new asset that has an extremely bright future. And when you take lower concentrated risk to volatility, you're going to be happier with it. And so if you can then select that hard asset with, by selecting a good partner, you've got a very honest, a lot of integrity. You can source the hardware correctly. You can maintain it. You can host it. That's a pretty unique thing to get to do. And, because the hardware has a residual value, you can sell it later and even, increase your yield that way. But, as far as just, the outright volatility in the market, is related to just buying it. And, my problem has always been in crypto is that there's only so much volatility you can take and still get a pretty big return. And, those things are always just continually mismatched. And, right now in a market, being wrong is very painful. And I think, we're all experiencing this in some way, shape, or form right now. But, this just pure Delta One risk exposure, not giving you a chance to be wrong, just complicates the narrative of growth in this asset. And I think, I personally think that Bitcoin should be higher right now. I think the price should be higher because of its inflation characteristics and because in one regard, it's a commodity. But it's just not happening because there's so much new money in it that is just having their first time being wrong, and that's dragging down the broader market when it could probably run on its own. So that's all these things put together. It's why I personally like to have like a yield generation strategy outright growth in the commodity rather than just kind of, kind of like solid 401k money, if that makes sense.
Yeah, no, it absolutely does. And I think like this is a personal opinion, but I think what we're going to see in this as a byproduct of this bear market, like we're seeing new entrants in the mining space, and we given the business that we're in, we see what a lot of different parties are doing, what retail investors are doing, what institutional investors are doing, and when there's blood in the streets, folks are buying. There's always going to be folks with dry powder that are unloading when you have depressed assets. And when I say, a depressed asset, I'm talking about a Bitcoin mining rig that market value, 10 months ago was like $12,000, $13,000. The same widget, S19J Pro 100 terahash machine, for example, that's now trading at a market value of, $3,500, right? So the asset hasn't changed. The asset that creates the asset, right, hasn't changed. The asset that's being created has gone through a bit of a dark time, and the optics aren't great. But I think we're going to see a fundamental shift, and we're starting to see it where the significant interest, largely driven by bigger institutional players of mining Bitcoin, is going to be less focused on, this is good and bad, depending on how you look at it, but less focused on kind of like a core Bitcoin ethos, sunken capex hardware, stack as many sats as possible forever and ever and ever, let the machine run until it's not profitable or it breaks, just dies, eventually down the road, right? And I think we're going to see a shift into more like ROI focused, capital allocations into mining, because what you are buying are ASICs, are computers, specialized purpose-built computers.
Did we lose Danny, or was that just me?
I think we lost him.
Actually get liquidity on the mining rig, purchase, right? And a little bit of a preview, one thing we're working on at Blockware is rolling out, for example, a tokenized, hash rate, basically rig marketplace, right? Because that enables investors, and it also brings in more investors who are not necessarily looking at this as a pure, stack as much Bitcoin as possible play, looking for an ROI. That liquidity aspect and effectively tokenizing an otherwise and historically illiquid asset to make it liquid. That's going to be a big transition. Right. And I was at the Digital Asset Summit in New York, and I was sitting on a banking panel last week, and they said just that. They said, tokenization of traditionally illiquid assets to make them liquid assets is going to be a game changer, right? And to my mind, as a Bitcoin, a Bitcoiner first and a Bitcoin miner, as well, it kind of just is starting to click, right? And it's going to take some time to play out, but the fundamental strategy there is these assets cost 13 grand, 10 months ago. Now they cost $3,500. If you believe in Bitcoin, and you wouldn't be buying miners, fundamentally, if you didn't believe in Bitcoin long term, and Bitcoin price action eventually ticks up, potentially famous last words, right? Then there's an interesting play there, right? So it's a, Joe, maybe just as we kind of get to wrap up here, what do you think about that shift? I mean, you see a ton in the mining space. Do you feel that that's a valid thesis, that number one, the realization of like a dividend paying asset thesis is valid? Number two, that the actual asset side, gain of that equation is going to become more enticing. And then number three, kind of bringing it back to adoption. Will this, kind of increase the velocity of adoption just into the broader network? What are your thoughts there? Super loaded 3-part question. Go.
Yeah, for sure. As far as thinking about, the hardware that you purchase, these, Bitcoin mining rigs, and also in relation to, the marketplace, or, being able to resell this hardware later on. I think it's interesting because, 5+ years ago, when the very first ASICs came out, you would basically mine these things and, mine them as fast as you can, and they'd be obsolete within like 12, 24 months. Now it's like the game has kind of completely changed. Like ASICs are basically commoditizing, and kind of what that means is when the next generation rig comes out, it doesn't immediately make the previous generation rig obsolete. An interesting stat that I found from the hash rate index, which has public historical secondary market ASIC data, ASIC price data, is that from May of 2020 to right after, or during the 2020 halving, to July of 2022, you could have bought on the secondary market an S9 for about 0.0035 BTC, and in July of 2022, it actually was worth 0.0047 BTC. So you actually outperformed Bitcoin, literally just holding, this hardware, not even like having it plugged in and actually mining Bitcoin. And so it's kind of fascinating to see that this hardware, unlike, pretty much every other like traditional computing hardware industry or product, actually can like not only just like retain its value, but in some periods it's actually outperformed just Bitcoin itself. So I think the game is kind of changing on how people think about, Bitcoin ASICs, and like how they think about modeling the price, or their, outcome of mining Bitcoin. And, there's a lot more consideration to be in, like, hey, like what's going to be the resale value of this ASIC? Because eventually, someone might buy this, they might continue hosting it, they might put it at a, natural gas site where, methane used to be flared, but now it's getting plugged into a generator, and ASICs are running off that generator, and the energy is effectively free. So if you have an old gen ASIC that's very cheap, that's going to be valuable to get plugged in there. So yeah, I think the game's kind of completely changed over the last 3 to 4 years on this hardware, and it's just because it's starting to commoditize, and that just means it doesn't decay nearly as fast as it once did.
Yeah, love it, man. One more thought I'll toss in there, and then we can wrap up here in a sec, see if we have any round the horn thoughts. Is, on that same topic about institutional participation in mining, largely catalyzed by, the option to get, disproportionate gains on the actual ASIC, right? To your point, Joe, like it outperformed Bitcoin by just holding the asset, by holding rigs, right? So I think it's it's a kind of a market, an asset class, if you will, that Bitcoin is novel relative to TradFi markets and other equities, bonds, so on and so forth, right? And then Bitcoin mining is like a derivative of that, not in a technical sense, but it's more novel, right? There's less adoption in Bitcoin mining, right? So it's kind of like one of these things where there's all these wild potential arbitrage opportunities for bigger players. Simply, here's one I'll just kind of toss out, like the economies of scale arbitrage opportunity. A big player, an institutional player with deep pockets can go buy 20, 30, $40 million worth of Bitcoin mining rigs, let's just say. And then they're obviously going to get a much better economies of scale discount kind of price structure than a retail individual buying one rig or 5 rigs, right? So there's a not illogical play in theory here where you could see big players coming in, buying rigs, plugging them in, lowering their cost basis while they hold for a little bit, but not like a 3-year period, and then simply selling them if they have an opportunity, to get liquidity without a lot of, lift on that, and selling at a disproportionate gain, you could buy rigs, just kind of spitballing numbers, 20% discount if you're buying in these kind of increments. Right. So, I mean, I think it's factors like these where big hitters go towards sure things. Right. And it does require an efficient market, a lot, continued, let's say, retail adoption. But I think we could see a situation here in the next year or so where, we see like OEM and large Bitcoin mining rig deals almost exclusively with institutions or deeper pockets, just broadly, and then rolling selling those out to kind of more retail focused clients who are still getting, relative to the market, because the market will be efficient, favorable pricing on those, right? And it could just kind of totally change the adoption landscape, which could be a very good thing for Bitcoin, right? I mean, in some ways, you can look at it a lot of different ways, but it's an interesting kind of outcome that we've been thinking a lot about. So, yeah. So with that, Joe, Blake, Mitch, Warren, anything you guys want to add before we wrap it up? We've gone about an hour, 10 minutes here, so we'll wrap it up here in a sec.
I think that's a really
great session. I had a great time.
Yeah, this was great. I really like that idea you threw out there at the end, Danny. I think Bitcoin, from like a financial perspective, I think retail is going to lead that adoption. But from the mining side, I definitely agree with you that that's going to be institution driven. And Joe did that report about 2 months ago about the Bitcoin miner. Basically, the cost to mine a Bitcoin essentially becomes the price floor, and as more money gets to put into Bitcoin mining infrastructure, that could form a floor for Bitcoin's price.
Yeah, right on, man. As we do the next one, let's keep an eye on that trend. As I mentioned, we are rolling out a marketplace, which we're looking to basically facilitate and enable that that outcome. So I think we're gonna have a lot of good data to share in the next couple months. Let's keep exploring it.
Yeah. Also, don't really have anything to add. I just I had a blast. It's always great to hear from you guys and you experts in the mining field, and I hope everyone enjoyed.
Yeah, guys. Danny, thanks for hosting. And as we mentioned at the very start of this, macro times are turbulent, but keep holding your Bitcoin, hold your own private keys, and if you can survive the bear market, you'll benefit the next bull market.
Right on, man. All right, everybody. Appreciate you tuning in. We'll do another one of these in probably about a month. Take care.
Thanks, everyone.